Okay. Hi, my name is Teresa Timms. I'm president of TDR Mortgage. My partner.
I'm Jocelyn.
And we went to a home buyer. Where's my little thing at? We went to a home. Did I not bring it? Crap.
Which one?
That little square one. Oh, it's Friday. Can you go get it really fast?
A word? I don't know what I'm looking
It's that little square one, that little pamphlet when we went to that thing. Okay, bear with us. Yes, that one. Okay, thank you. So, one of our lenders that we partner with, Mountain West Financial, put on a home buyer seminar, and basically, in order to maintain the utmost value and the utmost current opportunities in lending, we are constantly going and educating ourselves on the program. So I like to stay cutting edge on things that are out there. And even, sometimes when you know a program, having refreshers throughout the year are a very good investment of time. And so prior to that class, I don't think, Jocelyn, you hadn't been to one of those with me before, huh?
No, I had not. It was my first one.
So was it fun?
Yeah.
Yeah. So there's a lot of, whenever you do a regular loan, there are intricacies in regular home loan financing that you have to be aware of. But then when you layer a program onto an FHA loan or a conventional loan, it adds a pretty heavy layer of additional things that you have to look out for. And when you're a loan originator and you send somebody out to go write offers, the last thing that you want is to send a buyer out with a pre-approval for $400,000 and have the agent go work nights and weekends, get him in escrow a couple weeks later after spending 40 hours of drive time out in the field. And then because as a loan officer, you missed something, you missed an update, you didn't quite calculate the income correctly, and they don't qualify because of income or a variety of other reasons, it could be pretty, detrimental to the confidence of the realtor partner that's spending their time out in the field, and also to the client. So, we're highly motivated by staying cutting edge. And CalHFA is
CalHFA.
CalHFA, right? We learned that. CalHFA is one of the oldest programs, tried and true programs that I've been doing since 1998. And so today we just kind of wanted to talk about our takeaways in the from that class. So I want to start with CalHFA, which is the California Housing and Finance Authority down payment assistance. Down payment assistance programs are driven largely by two main factors: income and debt to income ratio, or qualifying. On buyer programs, the maximum that you can usually go, or any of the programs that I know, a 45 debt ratio. Whereas FHA, you can go to a 56 back in, and that means like normally on a normal loan they'd qualify to 400,000, but because of the 45 debt ratio, they're limited to 325. And so that's one of the biggest pitfalls and why most people choose to not use a buyer program. So I think my takeaway was it was just a gentle reminder about the conventional loans and the low MI that's afforded to someone going through the CalHFA program and getting a CalHFA first and then a CalHFA second and third, that on an MI loan, a regular conventional loan, where they're putting 3% down, if they've got like a 660 score or maybe even 680, the MI is so high, it makes no sense for them to seek out conventional financing. Jocelyn, your take on that?
So yeah, my take was, when you are looking for, first time buyer program like regular FHA, 3% conventional, 3% conventional, regular conventional without the CalHFA program, you're gonna need 3% plus your closing costs. But you have this opportunity through the CalHFA program to get a second, do a regular not a regular, but a CalHFA 3% first, and then go in and get that second for teachers, right? There's a new program for teachers. They can get this second for, up to 4% to the closing cost. So you really only need your down payment. So I thought that was really cool that I learned from the class, that I didn't know that was available or that was even a thing. I always thought that it was the CalHFA first, a second, and a third.
Okay. Well, cool. Yeah. The teacher one is kind of an obscure one. And that was a good refresher for us because we, when talking to the teachers, especially that demographic usually has a pretty secure job. They oftentimes have a little bit of money, but on a 3% teacher loan, 3% conventional teacher loan, you would need $25,000. And, a lot of teachers, especially just starting out, I mean, they often don't have that, big chunk of cash. So with this teacher program, we did a little thing. We did a lot of things. It gets really complex because, okay, so here, I'm just going to show this. So what do you have for a $400,000 sales price? What is the total monthly PITI payment?
With the CalHFA, you're looking at a $32.53 monthly payment.
Okay, $32.53.
That includes taxes, insurance.
Principal, interest, taxes, insurance. And what is the interest rate on that loan?
It's 5%.
Okay, 5%. Now you also, on a 640 credit score, you price that loan out with a regular conventional loan, and that rate was 5.25.
Yeah.
And the mortgage insurance is $407 a month, which that's a big chunk. And with the CalHFA, it's 5%, and you do get a little discount on that MI. Now, if you look right here, though, if you have a 760 or 740 score, look how low that mortgage insurance drops. I mean, you could save $300 doing that. So here in this scenario where we've got this $32.53, you could very well have your payment around $3,000. Conversely, getting in a conventional loan with 3% down, needing $24,000, Jocelyn put together a little sheet where with the CalHFA program, you can get some down payment assistance and only need about $15,000. So I wish there was a way we could, write it out, but I thought this would be the easiest thing to do. So you can see that. So you need $15,000. And, that we could even get maybe $5,000 or $7,000 of seller concessions to get a teacher in with $7 or $8 grand. So I think breaking it down, we have a little bit more work to do with the MI calculations. MI is very tricky because it goes off of a sliding scale. So when you're using a down payment assistance or regular, it goes off of a sliding scale. With the down payment assistance programs, it's much more generous and giving you that low, that lower rate. I think we did this thing, but it's going to be kind of hard to see, huh?
Yeah, it's really small.
So this is the one where if they had a 760 FICO, it's $94 versus $367. And this is CalHFA too, right? So, okay.
CalHFA, yeah.
Okay, so CalHFA, look at her correcting me. Let me circle that here. So this is a 94. That's really, really a big difference. So usually you find that with the conventional programs, here with the lower score, and then here with the higher score, $94. So it's a pretty big bang for your buck. And who doesn't love a big bang for your buck, right? Okay, so I think that's my CalHFA stuff. CalHFA is pretty basic. Oftentimes, the CalHFA program, CalHFA. Whenever we get a buyer in, we intake a buyer and we say, okay, look, this is what it looks like conventional. This is what it looks like FHA. This is what it looks like buyer program. So we're presenting all the options and educating the borrower on all the options. And typically, what does that look like, Jocelyn, when you're going through an exercise like that?
So today, right, I had a client call. They were referred to us by an agent. and they were working with another lender, and they were looking for a down payment assistance program or a first-time buyer program. So I went over the difference with FHA and CalHFA. So FHA, we are mortgage brokers, so we get wholesale rates. So percent plus your closing costs.
Oh wait, I'm trying to do the comments, and so hold on.
Went over the
Hold on.
difference.
Sorry.
Click right here.
I'm
On
clicking
comments?
there. Watch.
No.
See, it's not showing it.
Huh. So like the difference is, okay, so we're mortgage broker firms. So we get wholesale rates. So with FHA, the great thing about that is we can work with the rate to give you closing costs credit in your rate to cover your closing costs. So most of the time you only need your down payment. So this couple, they're looking at $300,000 houses, right? So they have $8,000 in the bank right now. If they were to do regular FHA, and they have really good credit scores, so we could cover all their closing costs, and then they only need $12,000 to put down, right? But they could also do the CalHFA with a first, second, and a third and come in with zero money, right? Their payment would be a little bit higher with the CalHFA program because the CalHFA FHA rates are higher.
Say that 3 times.
CalHFA
FHA
rates are higher than your regular FHA rates. So I went through that with them, and what happens most of the time is they're like, okay, I can get in with no money, which is great. They get to save their $8,000, but now they have a second and a third, which...
Well, I think too, the big thing is like 3.75 versus 5. And you know, CalHFA just did a rate reduction. It was like 5.5 or 5 3/4.
Yeah.
So now 5% or 5 1/4 versus 3.75. I don't know about you, but 3.75 is way sexier than 5%. And I think most borrowers, like, they try to figure out a way to come up with the money. And in this instance,
yeah, so he was like, okay, you know what? They have a few months to move out of their place. So he's like, I know that I can come up with the extra money I need to get the regular FHA to have the lower payment and not have to owe extra money and then owe so much. And then my equity is in jeopardy, which was his big thing, which is a really smart thing to do. But for those people that are really good with their finances and they have a really good job and they can qualify for like a $400,000 house and they don't mind the $3,500 payment with CalFHA because they don't need any money to put down, that makes sense.
Right.
Because you just want to own a home and you know you can afford it, but you can't save the money, then yeah, do the CalHFA.
Well, there's a huge value in home ownership. So don't let the fact that, you know, we have some people saying, oh, I don't want to do a buyer program because I'm going to owe 20 grand. Yeah, but in 3 years, your equity is going to be 60 grand. So you just lost out on the opportunity of $40,000 in equity. You lost out on the opportunity of write-offs, and you lost out on the opportunity to build and grow wealth. And you build and grow wealth primarily through real estate ownership. And so what we try to do is, you know, educate you on all the fine intricacies of that's really important. And not only that, like, you know, I don't know about you, but rent keeps going up. And so you're going to be leveraging yourself with this $3,000 payment. And it's not going to keep going up with the exception of, you know, your taxes and insurance, because the taxes, you know, do go up every year, et cetera. So I think that's a really good point that you brought up, and a practical exercise in what makes sense for you. And, you know, when you come to us and we go through all the steps, you have so much education. You're able to make your own decision.
No, and it's weird because today I had old clients come in and I got 2 new pre-quals over the phone. And the one thing that they all told me is, I really like that you guys explain and really narrow everything down. Like the 2 pre-quals that I got are working with other people that are not explaining the options that they have, 1, and 2, they're not getting back to them, which is ridiculous.
Well, yeah. Well, I think a lot of times, you know, in our industry, just like a lot of industries, you know, if you're not cutting edge and you don't understand things yourself, you're not going to be able to explain it and, you know, make it simple. And, you know, really, you don't have to make all your money on one loan. You're going to do one loan for this person, and then you're going to do their refinance, you're going to do their move up purchase, you're going to do loans for their family. So there's a big value in taking care of people at that onset of the meeting.
Yeah.
Okay. Okay, so that's CalHFA. Okay, so this one program, platinum program, I don't really like it. So every time I look at it, you know, they were like talking about it. I'm like, ugh, the platinum, it's so stupid. Oh my God, it's like 6% rate, 5.5% rate. And that's a 6%, that's super high. So when we look at programs that don't make sense, it's pretty easy to, I don't want to say sell against it, but find reasons why we're not even presenting that program because it makes no sense. So when you come to us, there's a lot of stuff we've already evaluated and ruled out that you may not even know that we ruled out just because it makes no sense for you. Yeah, I mean, for the most part. But this platinum program, it was a refresher on how it does make sense. Do you recall how it makes sense?
The thing that really stuck out to me the most was that you're getting a grant, and in 2 years, was it 2 years or 3 years, you don't have to pay it back as long as you still live in the property. So versus the CalHFA, I mean, if you are selling me a house, or if I'm buying a house and I know I can get this grant that I know I'm going to live in this house for at least 2 years, and then I don't have to pay that grant back, like, that's, why not do it?
Hey, free money! Woo! Sign me up, I'll take 2.
Yeah.
Okay, so so the platinum program, where I would find a value in recommending this program would be if you're in the health and safety field, minus being a nurse, so a police officer, firefighter, a teacher, and there's a whole myriad of professionals that fall into that category. You would, again, buy this $500,000 house. You could do a 3% down conventional program, low MI. $400,000, you'd get 5%. So that's like 20 grand, 20 G's. So you know what? Maybe your rate is 6%, 5.5%, 6%. So we get you this money. The day after this loan closes, you don't pay that back. It's free money. You can, it's $20,000 of free money, $400,000 purchase price. So you can't go higher, you know, depending on your qualifying. Remember, 45 debt ratio, so you're going to be limited or restricted to that. But the day after it closes, you are relieved from paying that back, unlike the CalHFA, that you do pay that back. It's low interest, but you do pay it back. And then 6 months later, you can refinance with no harm, no foul, no penalty. So when I looked at that, I'm going to do its own video and break that out and really market that to the professions that applies to. But to me, that was super, super huge takeaway. What were your thoughts on that? Like free money?
I said, yeah, it's free money. I don't have to pay it back. As long as I live in the property for 2, like, that makes sense to me.
So no, on the teacher one, you know, if you're the qualifying professional, there's really no restriction. I mean, anytime you buy a house, you buy it with the intent that you're going to live there. Oh, you do have to live there 3 years, or you have the recapture thing. Oh, you're right. Look at you. Hey,
I was paying attention.
My girl. So yeah.
Yeah.
So then what about if you got that money and you live there 3 years? Is it all the way? Let's say you're not a teacher, you're just Joe Blow, and you, I don't know, whatever your profession
Well, there was
is.
something about the teachers that I didn't pay attention.
Okay.
So we will get more information, but for the most part, it's free money.
Yeah.
And we will narrow it down.
Yeah. So I just, and always when you layer something over a regular loan, you're bringing in an additional complexity issue that you really need to sit down and break it out and understand it and make sure that, you're delivering this expectation that you can close on, because it would really suck. Oh, hey, it's free money, but then it's really not. No, that wouldn't happen when you come to TDR Mortgage. We would not do that to you.
We got you back.
We got you. Okay, what about, okay, so that's that. Oh, I didn't even mention the MCC thing, huh? Because we did, that was a thing.
It was kind of dumb when we looked into it.
Okay. Okay, so
we're good at dissecting and throwing out what we don't need.
So we were like, oh, MCC. Okay. Okay, so mortgage credit certificate program. I've been doing loans since 1998. And every time I get started down the path of doing the mortgage credit certificate program, I think it all sounds great. Let's do it. And then when you really dive in deep, it's not applicable on a lot of levels. What I will say, though, is that through Mountain West Financial, the mortgage credit certificate program, I have a client right now that we're working on, and we can only get them to 337. And it's because of student loans, these darn student loans with, now when people go to school, you have $60,000, $70,000, $80,000 of student debt is not uncommon. And if on the credit report, you've got a $9,000 loan and you're paying $15. Tell me about that, Jocelyn. Why does that not work?
It doesn't work for FHA because FHA wants to make sure that you are paying your debt down.
Eventually.
And you're going to pay it off. But the way that these student loan companies do it is they do it based off of their calculations, and you're not really paying towards your principal pretty much. So it's not amortizing. You're never going to pay it down.
So when you say amortizing, tell me specifically what you mean. If you've got this $8,000 debt and you're paying $15 a month, and every year you're adding to that balance.
So the way they want to see it is how much time do you have left in your loan times whatever you're paying. Will that pay that debt off?
In a certain period of time,
right.
Like 10 years, 20 years, 30 years.
If you have 10 years left and with making that payment, you're going to pay that debt off, then they're fine with it. But if you have 5 years left and you're only paying $15, you're not going to be able to pay $8,000. So that's how they calculate it.
And that's FHA.
Right.
Tell me how FHA 56.7, 56.9 debt ratio, which the qualifying is 325 versus a 45 back end at 400. So on conventional.
So on conventional, they will go based off of whatever is in your credit, but now you're limited to how much you qualify for.
Yeah, so it's just like,
and the rate is higher.
Right,
so it's just like, and you need more money because we can't cover your closing costs.
Yeah. So okay. So it's just like, so then you're like, okay, let me go put back on my thinking cap and be just like, so this MCC program, one of the things about it, it's a mortgage credit certificate program that gives you an additional tax credit at the end of the year. So my people that qualify for 337, I was like, oh, I could get them if they buy in San Bernardino County. I could get them an extra. There's a calculation, a formula. I can get them an extra $225 of income from that $3,000 annual savings that they're going to get. So I'm like, oh my God, I'm a freaking genius. And I'm like, texting my processor, Terry, blah, 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 let's rerun it and calculate it with the extra $225 income. And so then she's like, yeah, but what about this? What about that?
Like, hold up. Let's read the guidelines right and get it correctly.
And then so what happened in that scenario?
So there's limitations per county.
For income.
Per income. So if you have two borrowers that make over the income, then they can't qualify for the program. So
because with an extra $250 in income, I was like, okay, you guys qualify for 360. Let's rock and roll. If you can find a place for 360, you know, 337, you could do it still. You know what, if I only qualified for 337, I would find a house. I would buy a house and I would have a place and I would have a tax write-off and I would have equity gains and I would be creating wealth. I would not limit myself on sales price, especially if I was out in this area. Yeah, maybe if I worked out in Irvine, I probably wouldn't buy in Moreno Valley. I probably wouldn't.
Right.
Yeah, that's too much of a drive.
Yeah.
Yeah, I would I need a life.
Yeah.
But so that's, and then I was like, okay, cool, San Bernardino. So we could do it in San Bernardino, but then what about LA, Orange, and well, Orange is not really applicable. LA is not really applicable because the income limits are so restrictive. But then Riverside has it, but then you have to get approved with Riverside. And so again, that's why you're just like, MCC, you're stupid.
Yeah.
But but it is going to be like an ace in the hole. You know, I'm going to go check out the Riverside MCC program, get approved. Just that extra bit of qualifying, if that is make it or break it, and getting somebody to that next level where they really want to be and, you know, really want to buy, then I'm going to figure out a way to do it.
And then too, like, I mean, yeah, that was with this client, but maybe we have a client that is within the income limit. So now we know we can give you that extra money.
Yeah.
So you never know.
You never know. So that's my takeaways. Do you have any other takeaways?
No, that's it.
I don't know why I can't see my comments on here. It's really annoying.
Yeah, I don't know.
But did you see my burrito? Like, did you see it? Get that burrito. Hold
I'm
on.
scared to fall in this chair.
I still cannot get over this burrito.
They left the pen.
I know.
I told her she needs to call them. And
I've been busy, and then it's like $1.50 burrito
with a pen.
Yeah, and then it's just been sitting here for like 4 days and doesn't even smell. So then I'm like,
that's weird.
Yeah, it's weird. It's like that McDonald's thing. It's disgusting for even eating these burritos. Okay, so if you're looking to buy or sell in Southern California, what should they do?
You need to pick up that phone and give us a call at 909-920-3500 because we will give you the best option for you.
Yeah, we will. Yep.
We will dissect.
Okay, now go have a wonderful Friday evening and have a drink and cheers to us, right?
Yes.
Yes. Or we cheers to you. No, we should cheers to you.
Cheers to everyone.
Okay, bye.